Hey there. Today, we're diving into one of the most mysterious and thrilling strategies in the stock market, short selling. You'll learn how to make money not just when stocks go up, but also when they go down. Stick around until the end to understand how not to lose all your money when betting against the market. Support the channel with a like and a subscription. Short selling isn't just a trading term, it's a mindset, a position, a way to profit from what others lose. It's a risky, advanced, and sometimes destructive tool. But that's exactly what makes it so appealing. Let's break down how it works and why it demands serious caution. Imagine this. You're convinced a company's stock is going to drop, but you don't actually own any shares. So how do you make money off the decline? Simple. You sell something you don't own. That's short selling. You borrow shares from your broker, sell them at the current high price, and then hope to buy them back later at a lower price. You return the shares and pocket the difference. That's the trick. Sell high, buy low, but in reverse. Sounds paradoxical, right? Selling what you don't own? But in finance, almost anything is possible, especially with brokers, margin accounts, and a bit of client trust. This isn't magic. It's a system governed by financial institutions. Still, be careful. Mistakes here are expensive. Let's compare long and short strategies. Going long means you buy an asset expecting it to rise. Your worst-case loss is just the money you invested. Your potential profit? Technically unlimited if the stock keeps rising. Now flip that. You go short. You sell something you don't own, hoping it drops in price. But if it rises instead, your losses grow fast, with no cap. You can, in theory, lose an unlimited amount of money. That's what makes short selling the most dangerous weapon in a trader's toolbox. Join our Telegram channel where we post updates on new videos and articles. Links are in the description or the first comment. So, what actually happens in your brokerage account when you open a short position? After the sale, you have a negative share balance and positive cash. Let's say you sell 100 shares at $10. You've got $1,000 and minus 100 shares. If the price drops to $8, you buy back for $800, return the shares, and keep the $200. Nice. But if the price jumps to $12, you now need to buy them back for $1,200. That's a $200 loss. And if the price keeps climbing to 20, 30, 50, your losses climb right along with it. Margin call, the two words every short seller dreads. That's when your broker demands more funds in your account because the stock price is rising and your collateral is shrinking. If you don't top up in time, your broker will close your position to protect their own money. And that might happen at the worst possible moment, right before the market turns in your favor. The next level of trouble? Forced liquidation through an auction. If you don't repurchase the shares before the market closes, the broker is required to settle the deal, and they'll do it at an auction where the price isn't up to you. It's set by the market. And that price might not be pretty. Oh, and shorting isn't free. You pay to borrow the shares. And if they pay dividends, you're on the hook for those too. Yup, not only do you miss out on the income, you have to reimburse the real shareholder. Plus, shorting can only happen in a margin account, which comes with extra fees and interest charges for the loan. Here comes another beast, the short squeeze. Picture this. Most traders are convinced a stock is about to crash. Everyone's shorting. Then suddenly, good news hits, the price spikes, and brokers start closing losing positions by buying back shares. Demand surges, price shoots up even more, and boom, panic buying sets in. That's a short squeeze. Mass forced buying that pushes the price even higher. Still want to try shorting? Then be ready for another twist. Time limits. Most short positions need to be closed within the same day, especially with intraday strategies. These are called margin intraday settlement, or MIS. Sell in the morning, buy by the afternoon. Miss the window? The broker closes it for you. Some do this at 3:10 p.m., others at 3:20 p.m. Either way, you don't get to wait for the market close. Now imagine you're short and the stock hits its upper circuit limit, meaning only buyers, no sellers, and you're one of the ones who has to buy, but no one's selling. That's when your trade goes to the auction. After the market closes, your broker is required to buy those shares for you at whatever price the market offers. And that price is often way worse than what you hoped for. You could end up in a nightmare scenario where your repurchase order just isn't executed. That happens when a stock's price skyrockets, all the sellers disappear, and the market is full of buyers. The upper price limit is reached, your position hangs there, and time keeps ticking. The broker waits until the end, then steps in. They participate in a special after-hours auction where only brokers trade. Price is there, could be anything. Your loss-heavy position gets closed, often at the worst price for you. Your losses could not only wipe out all your gains, they could wipe out your account, or even send it into negative territory. We've published a new article on our website. You'll find free content on stocks, bonds, and ETFs, from beginner to advanced. Check it out and bookmark the site. There are other costs you can't ignore. Stocks you short might pay dividends, but you don't get them. You pay them to the person you borrowed from. Plus, you pay borrowing fees. And if the stock is rare or highly volatile, the rate could be higher, from 2 to 20% annually, or even more. Short selling is all about timing. How fast you react, how well you read the market, and how tightly you manage risk. It's like playing chess with real money. One wrong move and you lose everything. That's why shorting is considered an advanced strategy. Not for beginners. Sure, you can make fast, big profits, but the price of a mistake can be brutal. Especially if you can't manage your emotions or don't fully understand what you're doing. So, should you include shorting in your playbook? It depends on your skill level. If you can act fast, read charts, understand market psychology, and set stop losses, maybe. But if you're just starting out, stick to classic strategies, long positions, dividends, ETFs, not flashy, but way more reliable. There are more complex forms of shorting, like derivatives, options, and futures. That's next level stuff. There, you deal with time value, volatility, premiums, spreads. But the core idea remains: betting on a drop. Keep in mind, markets naturally trend upward. Companies grow, investors buy, economies expand. Betting against that trend is always a risk, sometimes justified. More often, dangerous. Yes, there have been times when shorting made millions, like in the movie The Big Short, where a few investors made billions when the U.S. mortgage market crashed in 2008. But those were outliers. Most traders who bet against the market end up differently, with a wiped-out account or debt owed to their broker. That's why the big players don't use shorting to gamble. They use it for hedging, to protect against losses. Say you own a company's shares, but worry they'll drop. You short an index that correlates with your portfolio. If the market falls, your stock losses are offset by short profits. It's complex, but effective. To wrap it up, short selling means betting against the market. You sell what you don't own, hoping to buy it back cheaper. Brokers lend you the shares, but the risks are huge. Unlimited losses, margin calls, fees, forced closings, auctions, and short squeezes. This strategy takes experience, logic, and nerves of steel. If you're ready, go for it. If not, keep learning. Either way, knowing how shorting works will help you understand the stock market better, who bets against the trend, why they do it, and how to avoid the biggest traps. Hit that like button and subscribe. Support our content on the membership platform. The link's in the description or pinned comment.